In one of my recent videos, I was showing off my long-term dividend tracker for pretty much every single stock and ETF that I have as of current, which currently earns me around $73,000 in dividends on a yearly basis. And on that video, someone commented and said, your portfolio looks pretty good as it is right now, but if you were to start over and build out a massive dividend portfolio with just 3 different dividend-paying ETFs, which ETFs would you choose and why? So in this video, we are going to be doing exactly that. I'm going to be sharing with you the exact 3 names that I would pick as of right now if I was starting over, which is $10,000, to build out a massive long-term dividend growth portfolio. Now, if you consider yourself a dividend investor, I definitely suggest you stick around, drop a like down below, and let's get right into it. I just finished my brand new dividend investing ebook where I share exactly how I went from 0 to now over 7 figures invested, and also on how I earned more than $6,000 per month in dividends. I also finished my custom dividend tracker that you can use to track your dividend income progress on an ongoing basis. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So first off, building out this dividend portfolio with just 3 different dividend paying ETFs, let's lay out some ground rules. These 3 ETFs all have to have the potential to grow in price over time, because the last thing we want is a portfolio decaying as time goes on. The next thing every single one of these dividend ETFs are going to have is they're going to have to, of course, pay a decent starting dividend yield of, say, north of 3% minimum. Now, this is because even if you are, say, a younger investor, I still personally think it's important to build a portfolio that's giving off a decent amount of cash flow, just because you never know, say, in 5 or 10, 15, 20 years. Within that time frame, you might want to use the portfolio to help cover some bills, or maybe at that point, it might be able to cover all your bills and more. Now, the last thing that's very important when it comes to picking these ETFs is that I'm going to want to look for ETFs that have the potential to pay more and more in dividends over time, which means that we're looking for dividend ETFs that offer a decent or, of course, massive dividend growth rate. Because simply, what's better than getting paid more and more as time goes on? Now, a lot of you probably already guessed the first ETF that I would have in this portfolio, this $10,000 dividend beast portfolio that we're building here. 1/3 of the overall portfolio would have to be the Schwab US Dividend Equity ETF, or SCHD. Now, the reason I would add SCHD into 1/3 of this long-term dividend growth portfolio, if I were to start all over, of course, is because SCHD literally crosses off every single thing I think every single dividend growth investor is most likely looking for. SCHD has grown in price over time pretty significantly, although, say, over the last 3 or so years, it's pretty much traded flat, which, to be fair, that's definitely worth some criticism. But SCHD also has a low expense ratio, which means it's cheap to own. It has around a 3.5% starting initial dividend yield. And best of all, this portfolio is going to pay you, or at least it has historically, paid people more and more in dividends year after year after year. Now, what this means is that even with a relatively small portfolio of, say, around $10,000, or in this case, we're going to be using around 1/3 of the portfolio, so around a $3,300 investment into SCHD. Over time, even if SCHD is only paying, say, 60 cents on a quarterly basis, or even 74 cents, over time, hopefully, at least if history was to repeat itself, those dividends are going to get juicier and juicier, to the point where SCHD could be paying over $1 per quarter, which means your yield on cost is no longer going to be 3.4, 3.5%. You're now going to be earning 4%, 5%, 6% on a yearly basis, all during a time frame where hopefully at least SCHD's price just goes up and up and up long term. Now, this ETF currently makes up a large portion of my portfolio, but if I could go back in time around 6 or 7 years ago when I first started investing, I easily would have bought a lot more of SCHD, and I kick myself almost every single day because I didn't. Because back when I started in 2017, 2018, I got to grab shares of SCHD at, say, $50 or so, and imagine my yield on cost and how many dividends I would have earned if I would have just bought more SCHD instead of so much of the other junk that I bought in the early days. Now, the next ETF that I would add in 1/3 of this portfolio if I was to start over and build out a monster dividend portfolio would most definitely be 1/3 worth of the JP Morgan Nasdaq Equity Premium Income ETF, or JEPQ. Now, JEPQ is a covered call ETF, which a lot of you guys might be saying isn't the best idea for a younger investor or an investor that has a long time frame ahead of them. But I seem to think, and like I said earlier, that even younger investors these days might find it valuable to build a portfolio that has a little bit higher yield right from the start, because a lot of younger people are looking to use some of their dividends a little bit early, or potentially even retire early. I mean, at least that's how I see things, and that's from my perspective, but of course everyone is different. But that being said, I would definitely pick JEPQ because it does have the potential to grow over time. JEPQ's ETF price is up almost 20% over the last year or so, which means this ETF, although is never going to be going straight up, probably because it is a cover call ETF and there is that cover call overlay to sort of of cap the upside, of course, JEPQ is still in the green on the max time frame, and over the year, this ETF has done very, very well. Not to mention this ETF has a starting yield of around 9 or 10% and pays a dividend every single month, which again could come in handy if, say, 5 years down the line you want to start using some of these dividends to maybe cover some of your smaller bills, or of course you might find yourself where most of your JEPQ dividends could even cover your expenses. Now again, JEPQ is only going to be 1/3 of the overall portfolio, but I do think this could be a good potential option for an investor out there that seeks some total return, but also really favors cash flow along the way. Now the final 1/3 of this overall portfolio, if I were to start over and build out a $10,000 portfolio, would be none other than DGRW, the Wisdom Tree US Quality Dividend Growth Fund ETF. First things first, going over some of the basics. What is DGRW? A lot of you guys watching this video have definitely probably heard of DGRO. For sure have heard of things like SCHD and VU, but DGRW isn't talked about as much. And because of this, I think a lot of dividend growth investors could be missing out. But right here on the Wisdom Tree website, it says DGRW, the Wisdom Tree US Quality Dividend Growth Fund, seeks to track the investment results of dividend paying large cap companies with growth characteristics. Now, side note, I have made videos on this ETF all on its own and we've dug deep into it, so check out my channel and definitely watch those. But what's funny is that this ETF just came across my radar over the last year or so, let's just say, and this ETF is an absolute beast that is going to be a major position in my portfolio in the up and coming years. Now, what's there really to say? DGRW has grown significantly in ETF price over the past, say, 12 or so years. The ETF was trading at $25 around a decade ago and now is trading at around $71 per share. Not to mention the ETF has an almost 2% dividend yield and pays a dividend monthly, which again is going to come in handy for investors that want to utilize some of the cash flow to cover their bills, because again, most bills are paid on a monthly basis. Now, DGRW is also one of my favorites because of the holding breakdown. It has some of the best companies in the entire market in the top 10 holdings, things like Microsoft, Apple, AbbVie, Broadcom, Johnson & Johnson, and so on and so forth. Again, look deeper into DGRW if you consider yourself a dividend growth investor. This ETF is going to blow your mind. So there we have it. Those are 3 different ETFs that I would add into my long-term dividend beast of a portfolio if I was starting over with just a $10,000 investment. Now, it's funny, what I wanted to note on this video that I made is that a lot of these positions that I picked in this video to choose are relatively small positions in my overall portfolio, which just shows that over time your mind and your strategy is most likely going to change. And that's why I always tell newer investors to, of course, do a ton of research and really figure out what you're doing before you invest your hard-earned money in the stock market. Because after all, if I were to start over as of today, I wouldn't have nearly this many positions in my portfolio. I would have a much more condensed portfolio made up with a lot more dividend growth ETFs instead of a lot of these single stocks that I purchased years and years ago. Now, the great thing about building out a long-term portfolio is that it's constantly evolving and you can, of course, trade in and out of things, and the market is very liquid, which I love. But when it comes to building out a brand new portfolio with a $10,000 budget and you picking 3 different dividend paying ETFs, I want to hear from you guys down below. Which 3 ETFs would you pick? Drop the ticker symbols in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.